Somewhere in Lagos, a woman who sells phone accessories in Computer Village is opening her shop. In Kano, a textile trader is calculating his first order of the year. In Port Harcourt, an engineer is checking her salary alerts after the holiday. None of them may realize it yet, but the rules that govern their money have just fundamentally changed. Nigeria's new tax reform laws officially take effect on the 1st of January 2026. 4 sweeping pieces of legislation signed into law in June 2025 now move from statute books into everyday economic life. The Federal Inland Revenue Service no longer exists. In its place stands the Nigeria Revenue Service. Over a dozen separate tax laws, some dating back to the 1950s, have been repealed and consolidated into a single framework. But if you ask why Nigeria is attempting the most ambitious overhaul of its tax system in decades, the answer is not January 2026. It is not even June 2025. The answer lies in a paradox that has haunted this country for generations. Hello and welcome to Beyond the Headlines. I'm Lucky Jonathan. Today we are going beyond the announcements, beyond the policy documents, beyond the political noise. We are asking a simple question. How did Africa's largest economy end up with one of its weakest tax systems? And can these reforms actually change that? To understand what is happening today, you need to understand what came before. And what came before was frankly a mess. Nigeria has operated with a tax to GDP ratio of around 10%. To put that in perspective, South Africa collects about 27%, Ghana collects 13%, Kenya collects around 15%. Nigeria, with the largest economy on the continent, collects less than virtually every peer nation. This is not because Nigerians are uniquely resistant to taxation. It is because for decades, the Nigerian tax system was designed not for efficiency, but for extraction by multiple competing authorities. Consider what a business owner in Lagos faced before today. She might pay company income tax to the federal government, tertiary education tax, NIDDA levy for the information technology sector, NASENI levy for science and engineering, police trust fund levy, signage fees to the local government, business premises tax, tenement rates, environmental levies that often had no clear legal basis. Each levy came with its own filing requirements, its own enforcement officers, its own interpretation of what was owed. This was not a tax system. This was a jungle. The roots of this chaos reach back further than most people realize. Nigeria inherited its tax architecture from colonial administration, a system designed not to build a nation but to extract resources from it. After independence, successive governments layered new taxes and levies on top of old ones without ever rationalizing the underlying structure. The oil boom of the 1970s made the problem worse, not better. When petrodollars flowed freely, there was little political incentive to build a functional tax system. Why chase small traders for compliance when you could simply pump more crude? But oil production has declined from peaks of 2.5 million barrels per day 2 decades ago to an average of 1.3 million barrels between 2021 and 2024. The money is no longer flowing the way it used to, and the bills keep coming due. This is the context into which President Bola Ahmed Tinubu stepped in August 2023 when he inaugurated the Presidential Committee on Fiscal Policy and Tax Reforms. He appointed Taiwo Oyedele, a renowned tax expert, to chair it. The mandate was ambitious. Take a system with over 200 separate taxes and levies and compress it into something manageable, something modern, something that might actually work. Within 30 days, Oyedele's committee delivered its first recommendations. Within a year, they produced draft legislation. On October 3, 2024, President Tinubu transmitted 4 tax reform bills to the National Assembly. And that is when the real fight began. What happened next reveals something profound about how Nigeria actually works. We'll be right back. Welcome back. So, the bills that President Tinubu transmitted to the National Assembly were not just technical documents about tax rates and filing deadlines. They were political explosives, because embedded in them was a question that has divided Nigeria since independence. Who gets to keep the money? The most contentious provision involved value-added tax. Under the old system, VAT revenue was pooled federally and distributed according to a formula that favored population over economic activity. Lagos State, home to Nigeria's commercial capital, contributed over half of the national VAT pool in 2024, about 2.27 trillion naira. It received back only 460 billion. Rivers State, with its oil and gas operations, contributed 832 billion and received 188 billion. Meanwhile, Kano State contributed 77 billion and received 117 billion. Some states received 5 to 10 times what they contributed. The reform proposed shifting toward a derivation-based formula, allocating 60% of VAT based on where consumption actually occurs, 20% based on population, and 20% shared equally among all states. To governors in Lagos and Rivers, this was simple fairness. To governors in the north, it was an existential threat. Governor Mohammed Zulum of Borno State put it bluntly: the north lacks the industrial base to withstand these reforms compared to other regions. States that depend on federal allocations to fund their bureaucracies, their security forces, their patronage networks would see their revenues shrink just as the costs of governance continue to rise. In a region already grappling with the highest poverty rates in the country, this was not an abstract policy debate. It was a fight for survival. After months of intense negotiation, the bills were amended. The VAT rate stayed at 7.5%. A new exemption was introduced for minimum wage earners. By May 2025, harmonized versions passed with broad legislative support. President Tinubu signed them into law on June 26, 2025. But even then, the controversy did not end. In the weeks before implementation, allegations surfaced that the gazetted versions of the laws differed from what the National Assembly had actually passed. Lawmakers demanded answers. Civil society groups filed lawsuits seeking to block implementation. The Nigeria Labour Congress president vowed to reject the new laws entirely. The government pushed forward anyway. On December 26, 2025, just days before the implementation date, Taiwo Oyedele presented the final Tax Reform Act to President Tinubu in Lagos and confirmed that the rollout would proceed as scheduled. So, what actually changed at midnight? The architecture of Nigerian taxation has been rebuilt from the ground up. The Federal Inland Revenue Service is now the Nigeria Revenue Service. A new Joint Revenue Board has been established to coordinate federal and state tax authorities, harmonize databases, and conduct joint audits. The goal is efficiency. Fewer agencies knocking on the same door for the same money. Multiple overlapping levies have been consolidated into a single 4% development levy on company profits. The tertiary education tax, the NIDDA levy, the Naseni levy, the police trust fund levy, all rolled into one charge. For large companies, this means filing one return instead of 4 or 5. For small companies, it means something even more significant. Under the new framework, businesses with annual turnover of 50 million naira or less and fixed assets under 250 million naira are classified as small companies. They pay zero company income tax, zero capital gains tax, zero development levy. They are still required to register and file returns, but the tax liability itself disappears. To understand how significant this is, consider that roughly 90% of businesses in Nigeria fall into this category. The government has essentially exempted the vast majority of Nigerian enterprises from company income tax. For value-added tax, the threshold is even higher. Small businesses with turnover under 100 million naira are exempt from VAT entirely. On the personal side, the changes are equally dramatic. Workers earning 800,000 naira or less per year, roughly aligned with the national minimum wage, now pay zero personal income tax. Above that threshold, a new progressive structure applies, with rates rising to 25% for the highest earners, up from the previous cap of 24%. For the first time, Nigerian tax law includes a rent relief provision. Taxpayers can deduct 20% of their annual rent up to 500,000 naira from taxable income. Essential goods remain protected. Food, medicine, educational materials, all VAT exempt. Where the net tightens is the digital economy. Streaming platforms, cloud services, app stores serving Nigerian consumers must now comply with Nigerian VAT rules. And for high earners, capital gains jump from a flat 10% to whatever their income tax bracket dictates. For someone at the top, that means 25%. But what do these reforms actually mean for ordinary Nigerians navigating an economy where inflation exceeds 30%? Consider the keke driver in Aba earning 400,000 naira in a good year. Under the new system, he is explicitly exempt. Nothing changes in his pocket, but his struggle is formally acknowledged. Now consider the accountant in Victoria Island earning 8 million naira. Her tax burden rises. The rent relief helps, but it does not offset the higher rates. And the market woman in Onitsha who has never filed a return. She must now register for a tax identification number. Her bank transactions are visible in ways they never were before. This is the fundamental tension. Gentler at the bottom, firmer at the top. But in a low-trust environment where many view taxation as extraction rather than a social contract, perception may matter as much as policy. The informal sector, over 60% of the economy, has never been captured by this system. Whether these reforms bring it into the formal economy or drive it further underground remains to be seen. President Tinubu has sold this as a way to stop taxing poverty and start taxing prosperity. But intent and implementation are different things. The Nigeria Revenue Service inherits a bureaucracy that has struggled for decades with corruption and selective enforcement. The first January filing season will test not just policy design, but institutional capacity. What does success look like? The keke driver who never worries about a tax bill. The tech entrepreneur who registers without navigating a dozen levies. Revenue that funds roads and hospitals, not patronage networks. What does failure look like? Enforcement without services. A digital dragnet that catches small traders while the wealthy shelter income offshore. The same old extraction under a shinier name. Nigeria has been here before. Grand announcements followed by inertia. The difference now is the oil money is running out. The luxury of postponing hard choices is disappearing. These reforms are a test of whether Nigeria can build the kind of state its citizens deserve. That is not a technical challenge. It is a political one. We will be tracking it all right here on Beyond the Headlines. Thanks for listening. I'm Lucky Jonathan.